Hi there and welcome to the Dukascopy Studios here in Geneva. I'm Jessica Walker and today I am joined by Allan Maksymec to discuss bond and equity markets. Welcome, Allan.
Thank you, Jessica.
So taking a look at bond and equity markets in Q1 of 2015, have the markets been positive and how so?
Indeed, it's been quite a quarter. We've had a lot of changes in the markets due to the central banks intervening in the markets. I guess the biggest one, maybe we've got a chart of this, the 10-year bond yield in the States has increased in volatility significantly. And more recently, just in the month of May, we've seen those yields really increase, which indicates that probably there's a rate rise coming fairly soon. Some say June, some are looking at September, and others look at December. But most likely this year we're going to get a rate rise, which is the first one in about 7 years, I guess. So that's big news. Followed by, of course, the euro dollar. We saw a significant move there, basically in the matter of a few weeks. The euro fell about 8% in value, so that is a significant event. And at the same time, the equity markets rallied about 18% in the Eurozone. So that was again due to ECB stimulus that they announced in January. I suppose the next thing that we should look at is, in the emerging markets, we've seen quite a spike in China, in the equity market there, as well as India. Optimism about new regulations, a little easing by the central bank there, and you see the result with the spike in the equity markets there. So I think that's really the main drivers that we've seen in the first quarter. There was a lot of money to be made, and depending on your positioning, hopefully you were on the right side of it.
So there seems to have been a limited amount of market corrections. When would this take place and why?
Right, so in this latest rally, which has now gone on for more than 6 years, basically since March 2009, we've seen 3 corrections, which a correction is defined as a drop in the equity market index of more than 10%. We saw the first one in spring 2010. Basically, the index dropped 16%. Second was in 2011. The index dropped, about the same, slightly less. Spring 2012 was the last one, and that was a correction of right around 10% as well. So it's been more than 1,100 days without a correction, and it's concerning for everyone because everyone's looking to try to discern what would be the next trigger for this correction. As we look at this, there's basically four triggers. The most obvious one is the U.S. interest rate rise, whether it's in June, September, or December. Markets usually look in advance of these events, and so we would expect a correction in advance of the tightening. The second would be geopolitical tensions. China, Iran, Syria, Russia would be, the areas to watch, as there is some tensions there now. The second last, is the Eurozone instability, dealing with Greece and the UK wanting to renegotiate its membership in the EU. These are things that create uncertainty and could cause a risk aversion in the market. And then the last thing, and probably the most significant, would be this, a sign of unsustainable recovery or unsustainable growth. Whether it be in the US, China, Japan, or the Eurozone, any of those regions, if they fell into another recession, I think it could really cause risk aversion and a correction.
So you mentioned corrections. How should market investors react when a market correction does happen?
Right. So the most difficult thing that you can do is to deal with a market correction. It's an emotional response that typically investors have, and we've sort of defined it as a sliding scale here. So a market drop of less than 5%, we call it a pause. Investors feel like whatever, it's not serious. 5 to 10%, it's called a dip, and it's refreshing. You know, it's nice that, you know, it doesn't just go up forever, and because it means that there is some limit to it. And then a correction is more than 10%, and that's actually where it becomes nerve-wracking, because that's a significant amount to lose in anyone's portfolio. And then beyond that, we get into the bear market, where you get panic, crash, which feels like torture, and you know, 80% is a depression, and that's really when you just feel like ending it. But you know, obviously, what we're talking about is a correction, so it is nerve-wracking. But the thing to do is to stay calm. How you can prepare yourself for one is probably more important. So going into a correction or preparing for a correction, the best thing you could do is to actually have cash. And so that means that you should take profits on a regular basis. You should rebalance your portfolios, which is what we do for our clients. And that way you've got some cash to put to work in quality companies when that correction comes. And it feels much better being on the buying side of you know, quality stocks at reasonable prices than trying to get out of some of the lower quality investments that you may have that had profits, and now you're at a loss. So, you know, given the two sides, I'm sure that most investors would choose to be a little prepared for the correction. So that's basically what we're telling our clients.
That's great. Well, thank you for coming in today, Alan. It was an absolute pleasure to talk to you.
Great, thanks.
Well, that's all that we have time for today, but for further updates and interviews, do check out the Jukascopy website. Goodbye for now.